All right, what's good, everybody? Mo Sunday service. Today we're going to be talking about NVIDIA's quarter two earnings, really going into the fundamentals of the stock, uh, not just telling you what to buy, what to sell in terms of NVIDIA, but like actually going into the data, looking at their revenue, what's good, what's bad, to try and make like a fundamental investment decision on NVIDIA. So, with that said, for everyone out there on YouTube, this is for informational purposes only. Investing and trading is risky, so do so at your own peril. Please refer all of your investment and trading decisions to your licensed financial professionals and do your own research. So, with that said, let's get started. So, NVIDIA reported earnings last week, and let me go directly into the expectations that everyone had before they reported. So, from an earnings per share standpoint, they were expected to report an earnings per share at 64 cents. They were expected to have revenue at 28.73 billion, right? And what did they report? They reported 68 cents on earnings per share, which was a 5 to 6% surprise. And they reported 30.04 billion in revenue, which was 4.5% beat on their expectations, right? So we're like, okay, Nvidia looks like it's still doing well. Look at the last 4 quarters, it's beat its earnings expectations, it surpassed its earnings expectations, right? So the stock's supposed to go up, right? Not true. The stock did not go up. And we were talking about this, Isaac, when it happened. Even though it surpassed its earnings expectations, let this be a reminder to us all that just because you beat your earnings expectations, or if you don't meet your expectation, doesn't necessarily mean that the stock is going to go up or down, for that matter, which is why I don't suggest trading a lot of stocks before their earnings, meaning like making an earnings play. You might as well go to the casino. What I would suggest is making a play on NVIDIA based upon the technicals, meaning like where you actually want to get into the stock. Like if you would have got in on this candle, or me, I know my price right now for my shares is around 106.70 something, in terms of when I got into NVIDIA. So just because it beats its earnings expectations doesn't mean that the stock is going to go up. And as we see here, it went down all the way to a low of about 116.71, right? So why is that the case? Well, because people had greater expectations for Nvidia, specifically investors, than what all the analysts were saying, right? That's the only justification that I could have. Like, people wanted to see a 10%, 15% earnings beat, not a 4.5 or a 5% earnings beat, right? But so the question still remains, should I buy NVIDIA stock? Should this be something in my long-term portfolio? And my answer to that is, of course, right? The issue is, where do you get in? Where do you want to buy this thing? And so when I say of course, why am I saying of course? Well, let's go look at the actual earnings now. So if you want to find NVIDIA's earnings, what you could do is just type in NVDA, the ticker, and investor relations, and you'll get to their investor relations tab, right? And then if you go down, typically if you want the more formal information, you want to get the 10Q. What I've noticed is sometimes right after they report earnings, the 10Q may not be up yet, so you might have to get the press release or some other document that they might have that'll have like the most important information on there, but you can't really go in depth sometimes until you get the 10Q or until the 10Q is posted. Also, I would encourage you guys to listen to the webcast or essentially the quarterly announcement from, usually it's either the CEO, the CFO, or somebody high up in the company that's going to tell you what to expect for the next quarter or the guidance, because I've seen a lot of times where the numbers look really good in terms of earnings, but on the press conference call or the call to the investors, which is usually a webcast or some sort of audio call that you can either stream live or download, they'll say, yes, we had a really great quarter, but we expect the economy to do really bad the next quarter, and so our sales are going to be cut in half. This isn't what happened on NVIDIA's call, but I'm just saying in general. And so you'll see a company get a bounce on great earnings, but then the stock will come down because on the press conference, the CEO or the CFO came on and said we're going to have a rough next quarter, right? So that's why playing earnings is an act of volatility, because you just don't know whether the data is good and that's what's going to push the stock up or down, or if the CEO or CFO coming on and saying something about the future is going to push the stock up or down. Because a stock could report bad earnings, but the CFO says we got 1 billion orders coming in this next quarter, so we know we're going to kill it this next quarter, and then you're going to see the stock push up, even though the earnings for this quarter may not have been that great, right? So go to the investor relations tab for the company that you're interested in. Check the 10Q, which are the quarterly earnings. And when you check the 10Q, this is what you're going to get, right? So scroll down. I usually like to see like the financial statements, specifically like the profit and loss statements. And so if you dig into NVIDIA's earnings, this is what happened. So last quarter, NVIDIA reported $13.5 billion in revenue. And this quarter, that is up double, right? This is why you should be investing in NVIDIA long term. They reported $30 billion in revenue, up like 17 billion from last year. There are not many companies in the market that have been able to double their revenue from the quarter of last year, right? Same thing if you look at their annual earnings up to date. Last year, it was 20.6 billion, and this year they're at 56 billion. That is more than double their earnings from last year. Or this is looking at 6 months, right? I'm sorry, not last year. Right? That's double. So Nvidia is still growing at a pretty hot pace. It just isn't growing as fast as other investors want it to grow. So for me, this is definitely a target on pullbacks to buy, right? Never buy it at its all-time high or at peaks, but if this thing pulls back, they are clearly still benefiting from this AI race that is happening right now. They have the number one chip, they have the fastest chip, and on the market still, you still got some competitors trying to build chips that are just as fast, but they haven't succeeded yet, and NVIDIA's chips are just going to get better. Now, another reason why the stock could have dropped is because Blackwell, their new chip has hit like some snags, like some delays. So, I'm not extremely concerned about this because we know their new chip is going to be better than their current chip, which is already still the best chip on the market. So even a short delay, a couple of months of a delay, I don't think is going to significantly harm them where they're still not going to be the market leader, right? So I assume this Blackwell chip is going to be even faster than their H100 chips, which are the market leaders. And if they are, it's still going to be harder to catch up to where NVIDIA currently is in terms of the speed of their chips, the network of programmers and developers that they have to make things, to make new creative things faster. Like NVIDIA is still A1. Like if we're talking about a picks and shovels company of the AI race, right? So let's go back. And if you want to get deeper into like their revenue segments, it's page 23 of their 10Q, right? Because they break it down like their data center revenue. Last quarter, 10.3 billion. This quarter, 26.2 billion. This just shows you that everyone is still buying their chips. When Facebook reported earnings, Amazon reported earnings, Google, Apple, all of those companies that reported before NVIDIA, they were all talking about how much they are investing, Tesla too, how much they were investing in these NVIDIA chips because they're all trying to develop their own large language models, or they're trying to integrate a lot of these AI components into their products currently. So, and this just shows that they are in fact buying Nvidia chips like crazy, right? And if you're a regular person, you can't even get these things. Like it's these billion-dollar, trillion-dollar companies that are spending billions on their compute, on their semiconductors, so that they can build the next products of the future. And if you just look at their data center revenue, which is primarily their chips, like it's up like from eight. That's almost a 3x increase from last quarter, 8.6 billion to 22.6 billion. Right. Their networking 1.7 billion, double to 3.6 billion. Right. Gaming is slightly up. It's one of their smaller revenue segments. Professional visualization and automotive chips, they're all up. But as you could tell, this compute segment, which is their H100 chips primarily, it's killing the game right now. And I don't think there's anyone that's comparable at this moment. And will anyone catch up in the next 5 to 10 years? Who knows? But Nvidia is so far ahead, and as long as there's this continued AI race, and as long as cloud computing is continuing to grow, I think their data center revenue is gonna look good for the future. And this is why Nvidia is the top one, two, three companies in the world right now. It's because of these numbers. Also, I wonder if their margins specifically, right? If you're looking at their gross profit, like their gross profit, this looks like what is 22.5 divided by 30. Let me do that really quickly on my phone. Their gross margins are 75%. So they're keeping like 70 out of every $100 that comes in, they're pretty much keeping $75 of that in terms of their gross margins, right? That's amazing, right? Because in a lot of these other $1 trillion companies, like their margins are like 30%, 40%, which is still really good. But like Nvidia's margins being gross margins being 75% is ridiculous. This is a really, really good business, right? So, what else did I have? The last thing that they announced was a $50 billion stock buyback plan, right? And people are debating on whether or not this is a good thing, but for shareholders, it is, because if the company buys back more of its stock, that means there's less dilution, which means that each stock that you own is actually worth more. So in the short term, that's good for stockholders because our stock, or like I own 175 shares in my retirement account. My wife owns 100 shares in hers. So for every stock, every share of stock that we have, like them buying back the stock and holding it, and so that means that there's less available to the public, means that my stock is less diluted and becomes more valuable, right? So that is why I like Nvidia long term. It's a great stock. The margins are amazing. It has a lot of cash on hand. Their CEO is an amazing dude. If you've ever like heard him speak, I encourage you to go to the Acquired podcast. I'm not sure if he was on ACQ2, which is like their podcast where they talk to like CEOs and whatnot. but the Acquired podcast did an episode or two on NVIDIA's company, and then they also sat down with Jensen Huang and talked to him about NVIDIA and just kind of who he is as a person. And like as a CEO, like it's going to be harder to find a better CEO than Jensen Huang too. So I love their leadership, love their profits, love their margins. It's really just where does NVIDIA dip where you might go in and try to buy something. So let's talk about that next. I'm already in NVIDIA. Hold on. Let me stop sharing this. Right. Me and a couple of the homies are already in NVIDIA. But if you're looking at, hey, I know I want to buy the stock, where do I get in? I always love fib levels and moving averages. Like, I'm sorry to tell you, is you had your days right here. You had about a week. 1, 2, 3, 4, 5, 6, 7. You had about 6 or 7 candles a couple of weeks ago to really grab NVIDIA on a pullback. And if you were the best of us, you grabbed it on this day when it dipped down to like 91 bucks. This is as close as it's gotten to that 200-day moving average and fib level that we've ever seen. This is the golden entry right here. Like that's where you want to get in. So if it ever dips back down to what, 93 bucks, don't hesitate, grab it. Right? So I would even say $95. Anywhere from 90, if you can get NVIDIA from $95 to $93, grab it. If I see it dip down to $95, $93, I'm probably going to buy some more shares, right? Just me personally. Will it ever get down another place if you're talking about swinging this or like kind of a shorter term trade, or you're just like, man, I don't think this is ever going to come back down to $95, but I want to hold this in my long-term portfolio and hold it for 5 years and not care? I would say try to wait if you can get it at like 111, 110. My old price is 110, but just to kind of show you my retirement account, NVIDIA, my trade price for NVIDIA is 106.74, right? So I got 175 shares in my account, and my break-even price is 106.74. But I really like it. If it, number one, 110 was the first time that I bought it, and then I got it down, I think, closer to like 102. No, if I bought it at 110, probably like 100 and maybe close to 100. I got some at 110, and I bought some more at 100. Probably on this day or on this day, something around there when it dipped. I bought some more, right? So if it gets back down to 95, 93, I'll buy some more NVIDIA just because I think this is a stock of the future. If anyone wants to lead the AI race, which is what everyone thinks is the next cash cow, the next internet, the next mobile phone race, like this is what people think is the next cash cow of the future, NVIDIA is going to play a huge part in that. So that's what I'm looking at. Like right now it's at its 50. It bounces off its 50 a lot, but I would be trying to catch it around, like I said, 111, 110, and to load the boat. If it gets down to $95, like I'm going to probably take some money out of my savings and then buy some more shares of NVIDIA. All right. All right. Let's talk about the market this week. So, in terms of what our catalysts coming up, and this is more for trading versus investing, we just talked about fundamental analysis. Fundamental analysis, I think, is only necessary in long-term investments. So we talked about NVIDIA more so as a long-term investment. If you're talking about just trading or swing trading, I don't think fundamentals are as important because when I'm day trading, I intend to be in that trade for less than 24 hours. And when I'm swing trading, usually I intend to be in that trade for less than 2 to 3 weeks on average, right? Some might go a month, but if I'm really swinging something, so I don't care as much about the fundamentals when I'm day trading or swing trading. I care more about the near-term trends, the short-term trends, what the Fed is doing. Is there any major economic news that's going to potentially affect one of my trades? So if we're talking about next week, we're closed Monday for the holiday. But we do have some potential hot zones that are coming up, right? The ISM manufacturing PMI is an inflation metric. It seems to me that inflation data has becoming a little less important than it's been over the last few months because everyone is pricing in the Fed cutting rates over the next couple of meetings as of this moment because inflation has consistently been going down, right? And how do I know that the Fed has uh, been thinking about or has been essentially saying it's going to cut rates? Because I've been following Jerome Powell's speeches. At his last speech, he all but confirmed that they're going to be cutting rates this next meeting that's coming up. And then if you go look at the CME Fed Watch tool, there's 100% chance right now, probability that at the September 18th meeting, the Fed is going to cut interest rates. 70% of people think that they're going to cut by 25 basis points because the current target rate is 5.25% to 5.5%. And so 70% of the people out there, the analysts, think that they're going to cut by 0.25%, and 30% think they're going to do a half point cut. So that's 100% probability for the Fed rate. It's just that people disagree on how much they're going to cut. 70% people think they're going to cut a little, and 30% people think they're going to cut a lot. Then if we move to the next month, right? So the current target rate is 525, right? 5.25% to 5.5% in terms of the rate at which the government loans money, right? So this is 500 right here to or 5% to 5.25%. In November, right? There's 50% of people think that they're going to cut again, and 41.8% to like 50% think they're going to cut even more in November. So we're essentially at a point to where they're pricing in two interest rate cuts at least. And let me go to December. Actually, they're pricing in three interest rate cuts before the end of this year. They're pricing in a cut at the September 18th meeting because they think it's going to be down to 5%. November 7th, everyone thinks that it's going to be at 4.75% or lower. And then in December 18th, everyone thinks that it's going to be at 4.5% or lower. So right now they're pricing in three interest rate cuts. And this is another reason that I'm kind of bullish on stocks for the end of the year. Not necessarily for September, but why I'm going to be holding on to my positions at least for the at least for the end of the year. Because if you've ever heard the term or the phrase, don't fight the Fed, right? If the Fed is cutting interest rates, that is great for companies in the US. That means that the expense to borrow money is going to be lower. The interest rates on money is going to be lower going into the end of the year, which means that's going to stimulate economic activity. If money is low, if it costs you less to borrow money, you're going to borrow more money. You're going to try to grow your company more quickly when the cost to acquire capital is a lot lower. Right now, the cost to acquire capital is high. So for a lot of these companies that are smaller, that aren't the Microsofts, that aren't the Googles, that aren't the NVDAs or the Amazons of the world, that need money, they need the money to borrow so that they can grow. It's going to be a better environment for them by the end of this year if the Fed cuts interest rates three times, right? So all of these smaller cap stocks, these regional banks, A lot of the real estate sector, especially the commercial real estate sector, they're going to see a reprieve where money is going to be easier to access, and things aren't going to be as tight as they are right now. So that's going to be bullish for the entire market. That should be bullish for the economy. And they're doing this because they're trying to make sure that we don't enter into a recession next year. So, one of the ways that the Fed can do that is by cutting interest rates to stimulate economic activity. So, right now, the market is pricing in 3 interest rate cuts before the end of the year. So, for those of you guys trying to buy a house, you might want to wait until December, until interest rates go down, because you're going to see a little bit of relief in that market as well, right? So, that's just kind of talking about trading. So, if we go back to like what we have for next week, um, jobs, right? So, depending on these employment numbers that we're going to get on Thursday and Friday, right? You're going to get initial jobless claims on Thursday. We're going to get the U.S. Employment report on Friday. This is also going to dictate maybe how much the Fed is going to cut. Are they just going to be cutting by 0.25%, or are they going to do half a point cuts, right? And if the job numbers are really terrible, let's say if the jobless claims, the expectation right now is 225,000 people out of work, right? If that number is like 300,000, then the Fed might start cutting deeper, right? Faster. So instead of in September cutting by 0.25, maybe they do a half point cut if these numbers are getting worse. Because once again, as I've talked about previously, the Fed has two mandates. Number one, keep inflation down. Number two, keep us near full employment. Right? So those are the two things that the Fed needs to make sure that they're trying to do for the economy. So if they see jobless claims are way higher than what we expect, then there's a good chance that they're going to cut deeper and faster. Same thing for Friday. If we are expecting 162,000 new jobs and it comes in like that last number we had was terrible, and it comes in at like 75,000 or 100,000, then we're going to get scared, right? And the Fed might cut deeper and faster, which is going to be bullish for stocks because companies can grow faster in low interest rate environments, because the Fed is actually trying to stimulate economic activity. Same thing with this unemployment rate. If we see this tick up to like 4.5 or 4.8 or something like that, the Fed is going to cut faster and deeper, because it's looking like if this number is really high, it looks like we might be headed into another recession, right? So that's just something to look out for next week in terms of trading too, because depending on how these numbers come out, it can move stocks. So if we see jobless claims that are expected to be in at 225,000 and they come in at 100,000, meaning that there's more work out there, that's not going to be great for stocks, because people are going to think the Fed is going to cut slower, right? And conversely, if these jobs are higher than 162,000 in new job openings, and they come in at like 300,000, then that might be some evidence for the Fed to go, you know what? Maybe we don't need to cut at all. Maybe the economy is still overheated. Maybe we'll wait another month. Maybe we'll slow down on our rate cuts. Maybe we won't go as fast as we thought we were, right? And that's not going to be great for stocks. So these are going to be two things that I'm going to be looking at next week, specifically the employment numbers, to kind of figure out what the Fed is going to do. Job openings too, right? That's anything job related right now is going to affect the market. So on Wednesday, Thursday, and Friday, that's primarily what I'm looking at is job numbers. And then really from an inflation standpoint, these PMI numbers for US manufacturing, I'm really like I'm really interested in seeing if these numbers are way off the forecast. If they're not, I think from looking at the CME Fed Watch tool, that interest rate cuts are already priced in regardless of what maybe the inflation numbers are going to do towards the end of the year. unless they are way they overshoot current expectations or undershoot current expectations, right? Um, and if we're talking about where am I looking next week to put on swing trades, so this is how I decide where I'm going to be looking potentially next week, right? We are at the end of month, so sometimes you do see some sector rotation coming at the end of the month, specifically in September. As we talked about last week, September is typically on average the worst month for the stock market. So if you're going long anything in your investment portfolio in September, you need to be very careful. Ideally, you got in on that August pullback that we have, um, and you're holding through maybe some September and October turbulence. But if you didn't, be very wary of investing in things towards their all-time highs in September, because from a seasonality standpoint, it tends to be the worst month for the market. But if you're looking for strength in the market for a swing trade, right, in areas that you think are going to continue pushing up, what I like to do is go to KoiFin. This particular market dashboard is free. You can upgrade as well. I don't sponsor them or anything like that, but I love the software. And this is a really good software or an app to show what particular sectors are doing and where are people rotating in their money and where they're rotating it out, right? And this might change because it's the beginning of the month, but if you're looking for things that are trending, and how I trade is I'm an exhaustion trader, at least on my swing trades, is I'm looking for really good stocks that are trending upwards, that are pulling back, and I want to buy them on a pullback in hopes that they are likely going to keep continuing in their current trend. So I'm looking for strength, but I'm looking for strength on a weak day, right? If that makes sense. So what's been strong over the last month? XLU, real estate, even though I don't really trade a lot of real estate because of liquidity. XLF, which are the banks, the major banks, financial stocks, right? So XLU, I'll mostly trade the ETF because there aren't a ton of names in XLU. I think NEE might be the most heavily weighted. XLF, you're talking about JP Morgan, Bank of America, Wells Fargo, Citi, American Express. I even think you got Berkshire Hathaway in there, right? So that's XLF. So what I would be looking at on XLF is, out of those names that I just named, which one is exhibiting the most strength? And I haven't looked, and I could go look. You know what? Let's go look at XLF really quickly. So if we look at XLF, right? As you can see, look at it. It's been exhibiting strength over the last couple of weeks. And what's the heaviest weighted inside XLF? JP Morgan. So look at JP Morgan. This is something, and I already have an alert there from last week that I need to take off because it is going to change based upon the new price. I will be waiting for a pullback on JP Morgan potentially, right? Because I love the structure. It looks just like XLF, which means it's going to move in conjunction with XLF. And actually, take this alert off too. So if I can get a pullback in XLF itself, I'll trade it with some options. If I can get a pullback in JP Morgan next week, I'll trade it with some options. Let's look at Bank of America. I don't like Bank of America as much. It's a little weaker than JP Morgan. So, but it's still been pretty bullish over the last couple of weeks from this down point. So I do like Bank of America too. I just don't like it as much as JP Morgan. You look at Citi. Citi's been pretty strong. I like this too, but I don't like it as much as JP Morgan. Wells Fargo looks just alike. So if you see, I just showed you pretty much the entire XLF sector, and everything has been pretty bullish over the last couple of weeks. And this is why I'm saying this is where the current strength is at. So next week, I'm looking for pullbacks on big banks. If I get pullbacks on big banks, that's what I'm going to want to trade. But JP Morgan looks the strongest. So I would really love a pullback on JP Morgan. But I am going to be watching these other banks as well. Right? And let me look at American Express. I like American Express too. American Express and probably JP Morgan are going to be my top two targets for pullbacks next week. But that's a particular sector that I'm looking at, right? And if you look at XLU and I think NEE, right? Been pretty strong, right? So, but I know XLU is a safety trade. So what I am going to be looking at is, hey, is the Nasdaq ticking up higher? Is the Nasdaq hitting all-time highs? If the Nasdaq is hitting all-time highs, the safety trade might be a little exhausted. So I would rather maybe trade an XLF names rather than XLU names next week. But that's where I'm looking for strength. If we keep looking, gold miners. So gold has been doing really well. So either trading GDX, the ETF, or I will trade GLD alongside the GC futures. So gold and then XLP, the consumer staples have been really strong. So the same names we've been talking about over the last couple of weeks, I'm actually in a Pepsi swing trade right now because look at XLP, right? XLP has been pretty strong the last couple of weeks. We're talking about the names inside XLP, Procter & Gamble. Procter & Gamble's been pretty sideways. It's going up, but so I probably wouldn't trade Procter & Gamble inside XLP. Let's look at Walmart. Walmart has been strong. I would love a pullback on Walmart. Costco, that's in my long-term portfolio. Costco hasn't been as strong as Walmart, so I would rather try to get a pullback on Walmart. Colgate, I would love a pullback on Colgate. Coca-Cola, been talking about this the last couple of weeks, so I would love a pullback on Coca-Cola. In fact, I already had a level set. That's an old alert now. And I told you Pepsi. I'm in Pepsi. Pepsi has been somewhat sideways, but I took it because the sector, it's in the XLP sector, right? I think I bought some at the bottom on this day, and I'm pretty much at break even on my trade, but I'm hoping that Pepsi catches up to Coca-Cola, right? So just in XLP specifically as that name, I waited for that pullback in a sector that's currently strong, which is XLP. Right, so and it's near all of these moving averages too, and you know how I love taking things at their 250-day moving averages. So I'm in Pepsi right now just to show you that I am in fact in Pepsi, what I'm currently trading, right, with some options. Right, my profit loss so far is $2. I lost $2, so I'm pretty much at break even because I got it at the very bottom of the exhaustion. And I'm in it with some calls, and my expiration date's about 3 weeks out, which is why I told you I am rarely ever in a swing trade for longer than 2 to 3 weeks at a time. 4 weeks usually max, but I'm usually going out 2 to 3 weeks, and that's where you usually find all of the liquidity as well. So I'm currently in a Pepsi trade, but what I really would love is a pullback on Coke and Walmart, right? So those are the two that I'd be looking at next week for pullbacks on, would be Coke and Walmart specifically. And then just to show you gold, looking at the futures, gold has kind of been on a tear in general the last couple of months, but I would love a pullback on gold as well. And I usually trade that through GLD, right? Or GDX, which is gold miners, not just gold. Right, but if you just look at the strength, I'm looking at the strength from the last month. What has been strong is likely to continue to be strong in terms of the probability. So that's what I'm looking at. And then so we talked about XLP. You also got XLV, which is healthcare, XLI, industrials, and then the communication names have been doing pretty well too. And then you see some tech that's actually catching up, right? But when you're looking at what not to trade, what has not been doing great has been oil services, metals and mining, oil and gas, the regional banks, and energy, right? XLE. So these are these are the things that I'm trying to stay away from and or short, right? If I'm going to be shorting anything next month, I'm probably going to be shorting oil and gas names because that has been the weakest over the last month. And what has been the weakest is likely to continue to be weaker just from a probability standpoint. So, yes, energy and oil could go up next month and we could rotate there. But if we're talking about the trends and following trends, what tends to be weak is likely going to continue to be weak, and what tends to be strong is likely going to continue to be strong until they exhibit a reversal. And then when these things reverse, then hey, maybe I'll start trading SMH and XLK more. If I see these names are the ones that start trending up higher, then I'm going to take these names that are in trend. But from what's been trending lately, we talked about banks, we talked about gold, we talked about consumer staples and XLP, and then let's go to healthcare, right? The one that I've been looking at inside of healthcare, XLV is the healthcare stock. You go look at the last couple of weeks. That's been really strong too. But a lot of times this isn't liquid enough to trade. I must have found some liquidity because I did set some alerts last week, right? But let's say if XLV is not liquid in its options, what I'll do is I'll go look at what are the major names in XLV. Johnson and Johnson. So I'm looking for a pullback in Johnson and Johnson. Right. They didn't hit my levels last week. I'm also, let's say, like Lilly. Lilly's options are usually really expensive. UNH. Right. If you look at the chart, it's pretty strong. AbbVie. Look at the strength. It's been pretty strong. So those are the names that I'm going to be looking at for pullbacks on next week as well, inside of the healthcare sector. And so all of these names that we're talking about right now are in the Dow. And the Dow has hit an all-time high. Right? It ended last week on an all-time high. So the Dow has been pretty strong. And what are the components of the Dow? Primarily, they are financials, which is what we just talked about. Healthcare. You do have some energy. Energy is the laggard. You have some industrials, XLI, which has been doing pretty well. And the things that are the major weighted stocks in XLI are GE, right? So I would also look for a pullback in GE next week. Uber's been doing pretty well over the last couple of weeks since it reported earnings. And then I think and then Caterpillar. So those are also some names that I'd be looking for some swing trades on next week, right? So I just gave you a bunch of options. These aren't the sexy names that everybody's talking about in terms of Apple, Microsoft, Amazon, Google. But I just went chart by chart showing you that, hey, if you had been trading these names that have been in trend over the last couple of weeks that aren't the sexy names, you would have done a lot better in your swing trading if you would have been trading these rather than the standard AMDs of the world, the Apples, the Microsofts, the Amazon, the sexy names that everyone knows, right? But if you would have been in some JP Morgan, you would have done a lot better, right? JP Morgan is not sexy, but it's what's trending right now. So from a swing trade standpoint, that's what I'm looking at. I go look at all of these stocks and these sectors that are trending really well right now, and then I'm going to go set levels on them and set alerts. And so last week, a lot of my alerts didn't get hit because these names continued to be strong, but that's what except for Pepsi, all of these other names didn't really trigger. But that's what I'm waiting for, is waiting for these strong names to trigger, check back to a particular level, and then continue heading up, right? Waiting for a day like this or a day like this, to come back, wait for it to check back, buy it on a pullback, and to continue for it to go up when it's exhausted. But those are the sectors that I'm looking in next week specifically. I'm looking at financials. I'm looking at healthcare. I'm looking at gold. And I'm looking at industrials. Those are the 4 sectors that I'm really looking at next week. Tech is starting to show some signs of trending, but given that we're in September, I'm looking for the more boring stuff, the safety stuff, where if tech dips in September's, that I'm going to be probably swinging more of the boring names, the safety stuff that people are going to be piling into if we see a market correction in the tech sector. All right. Isaac, almost done for today. You got anything you want to look at?
No, that was good. I like how you broke down all the stocks to look at and what was trending. So that was good information right here.
Right. So we see tech and semis are starting to trend, but the strength still is in these Dow names in those particular sectors that I just named. So if we keep seeing strength in those sectors, that's where I'm going to be placing my swing trades. And if tech wants to make a comeback, then I'll start swinging tech again once it becomes a little bit stronger and starts trending, and where the trend is a little bit more defined. But just because tech is sexy doesn't mean I'm going to be trading it. Of course, we all want to trade Tesla, Amazon, CrowdStrike, all the stuff that people are really interested in. But sometimes, man, Coca Cola and Pepsi might be the best thing for the next couple of weeks. You just got to look at where the market's going and go look at the charts. So, just looking at the charts, I'm showing you this is where the intermittent strength is. Long term, yes, I want to be in NVDA. But from a swing trading standpoint right now, like I'm in XLU, XLI, XLF, XLP, right? And then the names inside of those stocks and gold. That's what's been up lately. So that's where I want to be trading. And a lot of times that's great too because it's not crowded. Like it's not exciting to talk about gold on CNBC and to write an article about gold and industrial stocks or healthcare stocks. It's not sexy. So a lot of times a lot of people outside of the institutional investors and the professional and traders aren't looking in these places and they wonder why their accounts are going down. It's because you're not trading where the strength is. The strength is where the strength is. I just showed you the sectors that are going up. So trade in the sectors that are going up. When those sectors start going down, stop trading them. You know, trade the strength or short the stuff when they're short the things that are really weak. So if you know you're an oil trader, like don't keep trading oil up if the sector is showing you that the prices are going down, right? Of everything in the sector, start shorting that sector. Um, but I would still, considering we're still in a bull market, I'm still more biased towards things that are going up rather than the things that are going down because we are still in a bull market if you go look at the major indexes. So if we look at the Dow, you zoom out, we're still above the 200, well above the 200. And all of the shorter term moving averages, my blue is 50, my orange is a 34-day moving average, my green is a 20-day, right? And we're still primarily where the moving averages, the shorter moving averages are on top of the longer moving averages, which means it's still indication we're in the bull market. And the Fed is getting ready to cut interest rates, right? So from a macro standpoint, I still think we might dip in September, but I still think we're going to continue to be in a bull market at least towards the end of the year. And we're in a presidential election cycle, which is another reason why I think stocks are going to keep going up until the end of the year. If you look at the S&P 500 futures, still same thing, well above the 200-day moving average. 50 is on top of that, 34 is on top of that, 20 is on top of that, which means we're still in a bull market. The Dow, which has been the strongest lately, same thing, well above the 200, 50, 34, and the 20, and they're all sitting on top of each other the way they're supposed to be, right? And then the last one, the last main component of the stock market, which is the Russell, all the small caps, right? Same thing. We're well above the 200, above the 50, above the 34, the 20, and they're stacked in order the way they're supposed to be, which is indicative that we're still in a bull market. So I would rather be taking things long right now rather than shorting them. So even though oil is the weakest, we're still in a bull market where most things are going up. So I would rather take the things that are the strongest and take those long rather than taking the things that are weakest and trying to short them right now because we're still in a relatively strong market where most things are going up, right? All right. Anything else, Isaac, before we end today?
No, that was a good game, man. Appreciate all the info.
All right, for sure. Mokama Sunday service. Next time, if you want to be on the Zoom and you want to ask questions yourself, send me a DM or drop a comment in the video with your contact information, and I will send you the Zoom link. And, making it rain without the umbrellas. That's what we do here every week. Next Sunday at 8 a.m., we will talk about our next topic. If you have an idea for a topic, you too, including Isaac, and I'll send this to the group chat. Like, let me know if there's something specifically you want to look at, go over in terms of options trading, which is my main thing, spreads, long-term investments, anything of that nature. All right.
All commas.
Yeah.
Got it. Appreciate it.
Deuces. Peace.
All right, off record real quick, Mo.